another lesson. In this lesson, we are going to look at an exam that was tested in the year 2023 in financial management, and we are going to look at question number 3, that is an August 2023 sitting. Now, the question reads that by aid of a diagram, differentiate between systematic risk and unsystematic risk in relation to portfolio analysis. So let's begin. You're saying that unsystematic risk refers to uncertainty inherent in a company or industry investment, e.g. business risk, financial risk, and operational risk. Systematic risk is a risk that is non-diversifiable. You cannot diversify, e.g. interest risk and terrorism. You cannot, and terrorism. So those are, with the aid of a diagram, when you want to explain this, you draw a diagram this way. These are number of stocks in portfolio. Here we have portfolio risk. Here we have this diagram, and then we have here at this level. Here we have unsystematic risk eliminated by diversification. Here we have undiversified. In fact, this one was not meant to come all this long. Sorry for that. This one was just meant to come this way. Here we have undiversifiable risk and diversifiable market risk. You cannot eliminate this risk by diversifying. Means investing in different portfolios. Those risks will still occur. and here you have the total stock risk. So basically that's how to mean by risk diversification, or differences between systematic and non-systematic and systematic risk. We go to question number 2, or question number B. We are told that Utamu Enterprise operates a fruit juice processing business. The financial manager has serialized a consistent relationship among the following items as percentage of sales, and then those are the items. Then here we have the balance sheet. Additional information are told that the profit after tax margin is 5%, and the company sales for the year ended at 1st December 22 were 10 million. Sales is expected to grow by 10% every year for the next 5 years. The notes payable were paid off. Determine the external financial requirement for the business for the year ended. So we have to prepare you have to know the profit after tax, so that you can be able to determine the external financing. So here we're talking about external financing requirements. External financing requirements. This we shall draw this by 1. We shall draw a table. I will draw a table, and then in this table we are going to have several columns. We want 5 years. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. So let's look at increase in current assets. Increase in current assets. Increase in current assets. Look at this. Current asset currently is 650. Year 1 is 650, but we would be told that sales is expected to grow by 10% every year. The profit after tax margin is this. So we want to increase the current assets annually. So the first year will be 650,000. Yeah. Increase this one by 10%. Then you shall have 715. Then 786,000. Then year 4 we shall have increase again 865, 150, and the final year is 951, 665. Let's look at increase in non-current assets. Increase in non-current assets. Non-current asset currently is 2.5. This is 2,500,000. So here you have 2,500,000. Increase this one, you get 2,075,000. You see here, this was 2,075,000. Here we shall have 302,500. We're talking about increase only. So increase here we shall have 250, not the total assets. Increase only. 250, 275, 302. This is 332,750, and this is 366,025. Then we look at the total asset now. Total assets. Add this one, get 900, Add this one, you get 990. Add these two, you get 1089. Add this one, you get 1197 900. Add this one, you get 17 690. We less the current liabilities, less current liabilities. Current liabilities, we have 980, 132,000. Then we have 145 200, 159 700, 175 692. Then we also less profit after tax. We less profit after tax. Profit after tax, here you have 550, 16,0. This will give us 605. This is 605,000, 665 500, 732 050, and here I have 255 805. So we can now talk of external financing here. External financing. So external financing requirements: 1330. This one is 253,000. Then 278 300, 306 130, and 336 743. That is the external financing. Then we look at sales. Sales keeps on increasing. Shall require 11 million. This is 12 million, increased by 10%. This one is 13,310. Then we have 14,641,000. Then 16,105 100. So profit after tax. Profit after tax, we have 550,000, 605,000, 665 500, 732 050, and 805 255. So that is it about the external financing need of the company. We move at part C. We are told prepare a program statement of financial position. So here we need a program statement. Program statement. Program statement of financial year. Financial position. Program statement of financial position. Here there are 5 years, and we shall require a table so that it make our work decent. Shall have year 0 1 2 3 4 5, 0 2 3 4 5. We need to look at program statement. Now here we start with current assets. current assets as they appear in the previous question. Just pick them. 6,500. Here you have 7150. Then you have 7865. Then you have 8651 500. Here you have 951600. 9516 650. 650. And finally here we shall have 10468 315. Now these are current assets. Let's look at non-current assets. 2500, 2750. This one is 2500, 2.5 million. Even this one should be in millions. This should also be in million. 2750,000. That 25,000. That 327,500. That 616 250. And the last one is 4026 275. So total assets, total, this is 9 million, 900,000, 10,890,000, 11,979,000. Then we have 13,176,900, and finally 14,494,590. Those are total assets. Accounts payable. The first year is 1,000, then 1,100, 12. These are in thousands, so this is 1 million. So this is 1 million. Thousands. 12,10,000s. 13,31,000. Then 14,641. Then you have 16,10,510. We have notes payable. We have notes payable. Notes payable. They are only in the first 2 years. That is 1,200,000, 1.2 million, 1.2 million. The rest they are done. So we have current liabilities. Current liability totals. Current liability totals 3.4 million, 2,420,000, 2,662,000, 2,928,200, 3,221,020, and finally 3,543,122. The number of shares are the same. The ordinary shares have not changed. They are all 2 million, 2 million, 2 million, 2 million, 2 million, 2 million, 2 million. Now, once you identify the number of shares, what we do next here is look at retained earnings. So let's look at capital retains earnings. Capital retains earnings. The first company, it has 2.6 million, 150 million, 1,000, 3755, 442 500, 55, this is 5152, 550, and finally we have 5957 805. Let's look at long-term loans. Long-term loans. You have 1,000. This is 1 million. Sorry. Let's see, this is 1 million. This is 2,330,000. 2,473,000. 2,630,300. 2,803,330, and finally we have, this is 2,903,663. Total equity. Total equity. Ask yourself, what is the total equity here? Total equity. Here we have 9 million. Here you have 9,900,000. 10,890,000 is 11,979,000. 13,176,900 and 14,494,494. 14,494,590. So basically, that's how you are supposed to answer that question. That is question number 3. You are supposed to look at this and come up with the program statement, basically looking at the assets. Then the next one, was supposed to prepare a financial statement, the external financial requirement that was needed for this organization. Otherwise, we are going to stop there. We'll meet in our next video. Bye.